House purchase price or interest rate, which is more important? That is what's coming up in this video, so stay tuned. Hello, this is Sonia, your local realtor with Remax Realty Specialist. Welcome to my channel where we love talking about real estate and all things in and about Greater Toronto area, and we would love to take you along the ride. So hit that subscribe button and the little bell icon so you get notified every time there is a new video uploaded. Whether the sale price is more important than the interest rate depends on your perspective. All real estate is local. The complexity makes it nearly impossible to time the real estate market, but you can try to take advantage of the way the market moves. You can't always predict fluctuations in the market, but you can watch it move and learn patterns. And generally, the rule of thumb is when the interest rate goes up, sale prices move down to compensate. This has held relatively true over the years, though there have been exceptions. So the natural question is it worth waiting for lower home prices if interest rates go up? Obviously, buying a home for less, no matter what the interest rate, will be the best case scenario as you are borrowing less even though interest rates are higher. The cost of borrowing will be higher, but you are saving money on the purchase price. And now I'm going to discuss the advantages of the lower home price. Most hopeful home buyers dream of low prices, but if what that means taking on a higher interest rate, which is preferable. The immediate advantage of buying a home on the lower end of your price range is that you won't need to bring as much as cash to the table for down payment. If homes are more affordable because interest rates are high, buying a lower priced home could work to your advantage in the long run if you think rates will eventually go down. Once mortgage rates drop, you may have the option to refinance into a new mortgage at the lower rate. And now I'm going to discuss what are the advantages of the lower interest rate. Of course, having a low interest rate right off the gate is likely going to be better for you than having to wait for rates to drop and then go through the refinance process. But is a lower interest rate worth a higher price tag? In addition to lowering the amount of money you will pay to borrow the mortgage, low interest rates can give you a small boost to your buying power, since a smaller portion of your monthly payment go towards interest. This can mean being able to afford a little bit more house than you might in a high interest rate environment. Can there be low prices and low interest rates at the same time? It is possible for rates and prices to go down simultaneously. Low rates and low home prices can be indicative of a struggling economy. During an economic downturn, home prices may go down and the Bank of Canada may decide to lower interest rates to stimulate economic growth. This can be an ideal environment for a hopeful home buyer, but if you are struggling with unemployment due to down economy, you probably won't be able to take advantage of it. Additionally, it is hard to say whether you will encounter low prices and low rates at the same time, regardless of what the larger economy is doing, because home prices are so dependent on where you plan to live and what the housing looks like in that area, including whether you're in a buyer's market or seller's market. In general, this type of environment is probably not something you should hold out for, as you could end up waiting for a long time. And also there are risks of predicting. You can see why interest rates are a huge factor for many home buyers. If you are stretched too close to the top end of your price point and rates go up, you might not be able to buy that dream home you want because you will no longer qualify for that sale price. Conversely, if rates drop, you might be able to afford a significant jump in price. It can be tricky to predict interest rate changes. If you wait for rates to drop, you could miss out on the home you really want. Be sure you know what you are risking if you try to predict where interest rates will go next. Now let's discuss declining sale prices versus rising interest rates. Let's look at an extreme example to see how this might work. Note that interest rates won't normally stay the same for 25 years. I'm just taking two interest rates here. The number one is interest rate that we have seen in last couple of years and the interest rates that Canadians have seen over the past 20 years. Interest rates in Canada averaged 5.80% from 1990 until 2022, reaching an all-time high of 16% in 1991 and a record low of 0.25%. Suppose you were comparing a home in Mississauga worth $1 million. Your interest rate is 1.59% with 25-year amortization period. If you are buying in a declining market and waiting until that prices fall to 750,000, but rates went up to 5.5, you might be better off buying at a higher price. So let's compare it now. Suppose you put 20% down payment. Payment on 80% LTV mortgage for a 1 million home at 1.59 is 3,231 approximately. You will pay 193,887. Your principal paid will be 135,968 and interest will be 57,919. Your remaining balance will be 663,995 at the end of 5 years. Now let's see how that plays with 5.5% interest rate. Payment on a 80% LTV mortgage for a 750,000 home at 5.5 is $3,662 approximately. Your total payment will be $219,741. Principal paid is $65,658 and interest is $154,082 and the remaining balance is $534,225. For a 5-year term, you are better off buying a home with lower prices, assuming that the interest rates will drop after 5 years or at least go down after 5 years. And let's put another way. Supposedly, interest rates remain 1.59, say for 25 years. If you paid $250,000 more for the home by paying $1 million and lived in that home for 25 years, by the time you paid off your loan, you would have paid a total of $1,170,000 including your down payment. If you had paid $250,000 less by paying $750,000 but paid a higher interest rate of 5.5 for 25 years, by the time you paid off that loan, you would have paid a total of $1,250,000 including your down payment. In this instance, it is not better to pay less in exchange for a higher interest rate. As I mentioned, interest rates will not remain 1.59 for the long run. They average around 5.80, have the last 20 years. So in my opinion, you are better off paying low price than lower interest rate. And thanks for watching and don't forget to join me next week. Until then, stay happy and stay safe.